Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch. I'm Zinati Guma, and joining me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Drikus Combrinck from Capicraft. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. Let's actually start off with, I guess, the biggest corporate news. Not globally, I'm not talking about Nestle, but on the J... Very controversial, but on the JSE, the biggest was Shoprite. So, of course, it came out with its results. Because I'm going to start off with you. I mean, just when you think Shoprite cannot possibly give us any more significant growth, they continue to surpass our expectations. What have you made, and particularly just how investors reacted to those numbers?
Sure, it's great, and that's in a difficult economy. 15% growth, basically, double figures in this economy with inflation at 3%. Wow, we don't own it to my own. You know, it's not in our portfolios at the moment, but it might be going forward. It's not expensive at this stage. It's trading at a premium to the likes of Spar and Woolies and well, not Boxer really, but that's a different growth story. But it's very cheap relative to its own, let's say, 10-year multiple history. So yeah, I think Shoprite might be a buyer. Not my stock pick yet, but definitely looks interesting. One of the few growers in a difficult economy, and I think they're stealing market share. It's the 60-60. What do you call it? Motorcycles. Yes. Those are the guys stealing the market share.
That is absolutely incredible. And it's quite interesting because, I mean, for a long time, Shoprite has been seen as expensive, but a lot of people have continued to say buy. And of course, viewers asking, is it a buy at these levels? I mean, I think maybe I thought you couldn't buy because it would be expensive. But then I was actually looking at the chart, and it's actually still not at levels that it was last year. It's been higher than this. So, JP, would you also maybe look at it as still something that one could buy if they're not already in the stock?
Yes. Look, winners keep on winning. And Shoprite is the winner in the food retail market in South Africa. And they've made very good moves in terms of extracting capital and moving out of countries in Africa where they are not profitable, Ghana being the latest example. Selling the furniture business, a big chunk of capital that was locked in there. And good luck to Pepco, might be able to wring out more returns from that business. But the fact is that they unlocked these portions of capital that were effectively trapped. Means that although Shoprite has been expensive for a while, I do believe that the share is now in buying territory because the returns on capital have improved. So not only has the profit grown, but they're more efficiently using their assets. And if you combine that, even though it is the most expensive food retailer of the shares at the moment on a normalized profit basis, some of them have got depressed profits at the moment, it is the highest quality. It is the winner. So I prefer to stick with winners. Sometimes winners look too expensive, but there's a bunch of winners in other sectors that we've seen that keep on looking expensive, but as long as they keep on winning, it's the share to own.
Yeah, all right. Well, just on that, as we're talking about food retailers, I mean, going into something that's more mixed, that's Woolworths. Is it a buy at these levels? I mean, do you look at Woolworths still in a time when Shoprite is performing this well, Drikus?
Yeah, I'm just not there. If you're not doing something special in this economy, or if there's not something special happening, you know, with the capital structure, if you're not doing something to enhance returns to shareholders, I'm just not buying you at this moment. It looks cheap, you know, relative to its own history. It's not the Woolies that it was 10, 15 years ago. They've made a few bad asset allocation calls. Still not a bad business. But when I look at other retailers reporting, set aside Shoprite for this, for now, there's a big segment of the consumer is struggling at the moment. Yeah, I'm just not there.
I mean, where is Woolies trapped at this point, JP? And I mean, how would you be looking at it in terms of a buying decision?
So there's capital trapped in Australia. They unlocked the capital that was trapped in David Jones and in Australian property, but they still have Country Road, which is not performing well, but they still have significant capital deployed there. And look, just because something is performing badly, if you're an operating company, one division is performing badly, doesn't mean you should necessarily sell it right away.
Okay.
So I'm pretty sure that they would hope that things improve and then really consider whether they want to have this business in Australia, whether it makes sense, or whether maybe an owner in Australia would not be a more logical holder of that business. But it's probably not the best time to sell it right now. The Australian economy is also not in the best place. So maybe in the next few years things will look differently. And like we just said, what Shoprite has done, maybe there's an opportunity for Woolworths to do this in the next few years. If they can extract capital out of Australia by selling Country Road, hopefully at a decent price at that point in time, and deploy the capital better when it comes to the apparel business, the homeware and apparel business, that still is not generating the type of returns that we see in the food business. That can really boost the type of metrics that Woolworths shows in terms of their return on capital and their margins. They can't really separate the business. I know there have been other people saying maybe they can separate the business, but I mean, there's so many stores where the food is at the back of a big apparel store. I don't see them splitting the business, but they need to fix the homeware and apparel business. And I think it is fixable, but it is difficult in an economy where if you sell a premium product, people are looking for value for money and you are losing market share. So they need a better economy to really start shining. And until we get a better economy, I think it's going to be very difficult for Woolworths to improve on their financial metrics.
Well, I mean, still sticking to the food retail sector, a company that does perform well, even in a bad economy, is Boxer. What do you think about Boxer? It is almost 10 months, and this stock has never moved. Is this a failed IPO, and should I cut my losses? Failed, Drikus?
No, that's a bit harsh. Normally, what they try to do is, and coming from where Pick n Pay is, the accountants like to prop up the earnings before IPO, and I think a little bit of that has happened. It's quite bloated, the earnings, and I think they still grow, but it's difficult to grow from a bloated base. It's still not a bad business. It's trading at a hefty valuation, relative to other players. It's not a cheap share. But I won't call it a failed IPO. It's just, the normal hype around an IPO, a bit of bloated accounting figures, maybe. I don't know. It's, Okay. I left that one. I might return in the future if the price looks better.
Well, there's an added layer to this question, as the viewer is asking if they should cut their losses. They're asking, should I cut my losses, JP, and move to another stock like ASP Isotopes that had a 100% move yesterday? And I think I also saw an extension of those gains yesterday. I'm not sure then, I mean, if the move should be from one to the other. How would you be viewing this? Especially because I think, JP, a while ago, you also weren't too sure about ASP Isotopes.
Yes, I think those are two very different propositions. The one is a very solid, stable business that sort of like 5 to 10 years from now, you can envision more stores for Boxer, more clients, inflation, a higher top line. I can, in my mind's eye, see what Boxer might look like in 5 to 10 years. In 5 to 10 years, ASP Isotopes maybe has solved the world's problems with the type of isotopes that they make, or they might not exist anymore, one of the two. So you're either going to have a wonderful return when it comes to ASP Isotopes, or you're going to lose a lot of your money. With Boxer, I think the chance of losing money over a 5 or 10 year period is very, very slim. They would really need to mess up that business for you to lose money. So between the two, I don't think you've really made a loss with Boxer. We just spoke about ShopRite. ShopRite is also down from a year ago on a share price level basis, even though they grew their profits 15%. So the whole retail sector is down sharply. So to be only slightly down in a sector that's quite sharply down, I think is not bad at all. So I would rather stick with my Boxer shares. Yes, you'll miss out on the 100% a day rise, but maybe another day there'll be a minus 15 and give it all back. Who knows?
All right. I don't know if people are hungry today or what's happening, but this first half has been filled with food, with food companies. The last one is AVI. Would AVI be a good buy at today's prices? I get this feeling that there has been optimism around the food producers. What's your gauge of that, and particularly AVI, Drikus?
Yeah, so I'm not really sure why. It's not a bad business. Once again, it's a good business, but there's other food companies on the JSE that trades at a very deep discount. That's RCL. RCL has lost, they spun out Rainbow, which has always been the most volatile sector. Sure, the sugar cane, the sugar division has its own volatility and its own challenges. That's a big part of the business. But the rest of the business on RCL, it's not bad quality. It's a good business, and it's trading at a much lower valuation, or multiple at least, than AVI is trading at. So, yeah, I prefer RCL to AVI at this stage. But yeah, I won't stand in anybody's way buying AVI. I think it's a good proposition.
Yeah, quite interesting, because for most of this year, AVI has also just been trading in kind of a consolidation territory. Seems that investors are undecided about what to do with it. JP, your reading of AVI?
Yeah, I still hold it. I still think it's a high quality business. Remember, they've got a big chunk of retail business in there as well, some footwear and still a little bit of fragrances and cosmetics, stuff like that. So the food business is the biggest. And you do have the I&J business, which gives a bit of volatility to the food business. At least we got through the new total allowable catch rights being allocated as well as you would expect to go through that process. So now I still like AVI. Again, I like businesses where I can sleep well at night, and they might not shoot the lights out in the short term, but over 5 to 10 years, they compound at double digits. And when you open your eyes again, my goodness, you've done really well. And they're very cash generative. And the one thing about AVI is it's very cash generative. It's paid many, many special dividends over the years, very good capital allocation. Remember that they also had someone sniffing around, maybe looking at the business to acquire the business, which didn't happen in the end. And quite often what happens with these slide decks is the big corporate finance people, they put them in the drawer, and then 2 or 3 years later, they just, update the numbers and wipe off the dust, and lo and behold, you have the same plans that come to the fore again. So I really like AVI as a high quality business, and not a very expensive valuation, but it's a winner. Again, it's a high quality business that's a winner. So I would happily hold my AVI shares, and I do.
All right. There's a viewer that is asking if Richemont is a buy. We were talking about that winners will always win. JP, could you put this in that category?
Yes. So Richemont, winners keep on winning. Here's another one. When the luxury goods sector is seeing pressure, as has happened the last year or so, Richemont has outperformed its peers. It's done much better than LVMH. And I think it's on par with Hermes in terms of how it's performed. And poor Kering has really underperformed all of them. And if you look at part of the reason why, it's because Richemont is in hard luxury, the jewelry business. That's what's driving Richemont. Cartier is the biggest part of that business. And I mean, we're talking about the ultra rich now, but they're still buying their wives and there's something on the side, maybe a diamond bracelet and a nice watch and all of that. And the economy might be a little bit tough, but they're not feeling it at all. So it is as good a business as you can think of, and better than a handbag business, which is like the Hermes business and a big part of the LVMH business. Also better than an alcohol business, and better than more fashion luxury, like Kering with Gucci. So of all those luxury businesses, I think Richemont is the best quality. And I like the fact that Rupert the Bear, Mr. Rupert, likes to have a lot of cash around for when things turn bad, when things aren't going that well, because here we are. things are bad in the luxury goods sector, and Richemont is sitting pretty with a lot of cash on the balance sheet. So if he wanted to, he could make a proper acquisition, but he's biding his time, and I like that. So conservative management, conservative balance sheet, which allows one to be aggressive at the right time, combined with high quality business, that's what you get in Richemont. So yes, one again that you would struggle to buy it cheaply, because the winners don't really get cheap, but it's at a decent price. So I would own my Richemont shares. Yes.
Yeah. What's your feeling about buying a Richemont, even though it does not look cheap, Drikus, much like their products?
Well, no, this expensive. It's trading at a mid-20 PE, but it's sitting with a lot of cash. So actually, what you must do is you should look at it at, maybe at EV/EBITDA multiple if you want to use a multiple. And looking forward, it's sitting just close to 10 EV/EBITDA, which is at the lowish for Richemont. It's not at all expensive, and so it's a good company as long as the wealth effect holds, as long as world equity markets keep performing, and then that'll translate into a wealth effect, and the ultra rich will feel more confident and buy more of these luxury goods. That's together with some traveling. They buy these stuff normally when they travel. So those two, as long as they hold, Richemont will do well. We don't hold it, but I think it's not a bad proposition.
Just after I ask JP about Blue Label, Drikus, I'm going to come back to you as you're talking about traveling, a stock that is linked to that. That's Sun International. But in terms of Blue Label, JP, is it a hold or a sell? A lot of people, I mean, we know the acceleration that we've seen in the stock price, but I mean, over the last, I guess, 2 weeks or week and a half, we have seen that softening that they came out with their results. I can't tell you if I do understand those results, but investors were not happy. At this point, a lot of people had been saying that it maybe is a buy, but at this point, how would you be looking at it?
Quite a complicated situation, Zenati. So it's not only you scratching your head. A lot of us are scratching our heads. I'm scratching my head, and I think the circular, if and when it gets released on the back of Cell C, that will probably list, will give a lot more answers. But from what we saw in the announcement of the pre-IPO organization, it seems like Cell C has turned a quarter when it comes to profitability. But they were so loss-making in the past, they still have a hole in their balance sheet, roughly a 5 billion rand hole. And they need to fill that hole. And effectively what's going to happen is they're going to fill the hole through Blue Label, which is going to offer Cell C shares to the public. Now, that could be an attractive offer, or it could not be an attractive offer. It all depends on what we see in the circular that will be released. But the point is that it has turned a corner when it comes to profitability. Cell C has, but there's still a lot of sins of the past that needs to be sorted out. So that'll be sorted out in this whole complicated process. And then for the first time in a long time, you can look at Blue Label. What's it now? Blue Label Unlimited.
Yes.
Separately from Cell C, because they were so intertwined for so long, because the one needed the other for financial support, that it's going to be very interesting to see how they both do on their own two legs. Cell C will still be very closely associated with Blue Label. And there were very big financing transactions between the two and airtime transfers, and they're going to unwind a big chunk of that, with a big chunk of airtime being pre-bought by Cell C, according to that announcement again. So bottom line is we need to wait for the circular for more information, and I won't be doing much, and I definitely won't be buying until we get the details in the circular.
All right. Okay, Drikus, I did promise you Sun International. Please give your view on it. I mean, the viewer comments looks good for a buy. Drikus, would you be agreeing or not?
Yeah, once again, it's linked to consumer spending locally, at least. And the problem is, as a lot of the gambling profits, you have so many licenses, so it's supposed to be a good business. But, online gambling at the moment, the revenue of online gambling that's been extracted basically from South Africa is more than double what the local, all the licenses in SA's revenue put together. So a lot of money is firstly being extracted out of SA, which is a pity. Secondly, it's a deadweight loss basically. And then secondly, unless there's some legislation coming in to stop that, I don't see, it getting better for these operators. Maybe you can call it the experience stock. I don't know. I don't
Yeah.
gamble.
Okay.
Maybe there's something to it, but it's not what it was. It's not the same quality business that it was. So it's a pass for me. I'd rather own Southern Sun, SSU, which does not have any gambling exposure, and only owns hotels. And I sleep better at night owning that. I think it's £8 something, and the replacement value of all the hotels is nearer to $24.
Well, I mean, I wasn't going to come to you, JP, but actually Drikus makes a very, very interesting point on the gambling. And I mean, this has been an element that has been attracting investors to Sun International. And he'd rather have something that doesn't have gambling. What's your take?
Well, the part of gambling I don't want exposure to is casinos.
Okay.
It's the land-based casinos. So the part that's been growing that Drikus did refer to is online gambling. So the problem with Sun International is you're getting exposure to both. One part of the business is shrinking, the physical casinos, but the other part is growing, and that's Sun Bets, that's the online gambling. So you're getting a mixed bag. If you want exposure to gambling and you're comfortable having exposure to gambling, we have a company listed locally called Supergroup, but there's another Supergroup listed in New York, and that Supergroup owns one of our biggest online gambling businesses, and that's an interesting one. The other big online gambling business is privately owned. They sponsor every second sports team, especially in KwaZulu-Natal. But you can't invest in that one, sorry. But have a look at Supergroup listed in New York to see how well this company has done in South Africa the last few years. It's driven that company's growth. Even though they operate in multiple countries, South Africa is the one that has shot the lights out. So if you're comfortable with gambling exposure, look at that one. If you get a mixed bag in Sun International of physical casinos and online, it's okay, but it's not as attractive if you want the real exposure to growth, which is the online gambling business.
Oh, all right, very, very interesting. Well, let's go into paper and packaging. Mondi, why has the share price of Mondi dropped to an all-time low? Drikus, is it just the cycle? What's happening there?
Yeah, it's cyclical. The packaging is actually doing fine. More goods are being moved. Packaging doing fine. Prices are doing fine. It's the paper, fine uncoated fine paper. That's the problem. Prices are down, volumes are struggling, and costs for Mondi is also a problem at the moment. So yeah, it's cyclical. I think they're good operators, Mondi, but its time will come.
Okay, well, stock picks time has come. JP, where are you finding value today?
On the other side of the world, Zenati, in Australia, a company listed in Sydney on the Australian Stock Exchange, but South Africans might also know this name, Computershare. So it's a boring business. They effectively do the financial plumbing of shares and trading, custody, transfer, secretaries, looking after shareholder registers, all those boring things. But you charge a small fee for that and it adds up. And then you are always in possession of a lot of cash, not necessarily your own cash, but there's cash stuck on your balance sheet while it moves from shareholders to a company or vice versa, and you own the interest on that cash. And as we've moved into a higher interest rate environment, companies like this, which supposedly have a liability because it's not their cash, this is a liability that generates profits. And at higher interest rates, it generates very nice profits. So Computershare has seen an increase in profits about 18 months ago as interest rates normalized. And if you expect that interest rates are going to stay at these levels, if not go even higher, then companies with this business model of a float of cash that generates interest income is a very good business model to have. It protects you against inflation. So because of that, I find some value in Computershare shares listed in Australia.
All right. Drikus, where are you finding opportunity today?
Yeah, I'll talk about, holding cash. We spoke about Richemont earlier, holding a bit of cash. Reinet is going to hold a lot of cash very soon, about 600 Rand per share. It's trading at 520 something. 600 Rand of that will be cash any day now. And then you've got a few private equity assets on top of that as a sweetener. So it's extremely cheap. It's a special situation, call it the asset play. Yuan will do something with the money eventually, but I do think they will buy back some shares, maybe a small dividend. But I won't be surprised if they even go for something like Richemont, just chuck all that cash back into Richemont. It's not expensive at the moment. And then you'll get a re-rating immediately for any share price.
All right. Well, thank you so much, gents. That was very, very interesting. I really appreciate your analysis today. And that is all for tonight's Stock Watch. Thanks to our guest, Jean Pierre Verster from Protea Capital Management and Drikus Combrinck from Capicraft. Up next, the close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.